welcome to this AAB Budget Webinar. Regrettably, there is no lunch today, but I hope that there will be some morsels of food for thought. I'm joined today by two AAB colleagues, Derek Gemmell and Alistair Duncan. Later, they'll offer their reflections on last week's budget. Before we end the webinar, there will be an opportunity to tackle your questions. Please, as we go, post your questions on the chat function. We have a very special treat for you today to get us going. I'm joined by John Kay. John is one of Britain's most distinguished economists. His career has spanned academic work, think tanks, and company directorships, among many other subject areas. John's interests focus on the relationship between economics and business. He has, for 20 years, been a regular columnist for the Financial Times. I'm sure many of you have read his articles. And important to me, John is a friend. John, in this week's Economist, Rishi Sunak is described as a fiscal St. Augustine. I guess the elephant in the room, as we discuss the budget and forthcoming developments, is that £280 billion of financial support has been deployed necessarily in the UK economy. The Office for Budget Responsibility has reduced its forecast for the full outcome, but I guess that simply is guesswork. How do you view this mountain of debt, and what do you think the possible roadmaps out of it could be?
There are two aspects of this. One is, can we manage this debt and how do we pay for it? And at current interest rates, even this level of debt is really not so serious. You know, if we think of debt interest as a share of GDP, it's not spectacularly large. So I'm less worried by, as it were, paying off the debt than I am by the effectiveness of our recovery from all this. It's also important, and I think this needs to be given more attention than it's received from a lot of people. What has actually happened in terms of people's savings over the last year? I think if most of the people on this call think of what has happened to them, the kind of people who are on this call are typically people who are in the position that their income has not been affected very much by the crisis, but their expenditure is quite a lot less. We haven't been going out to restaurants, we haven't been traveling. And the result of that is that 6 months from March to September last year, which is what we have data for at the moment, we normally save 7 to 8% of our incomes. That 6 months, it's 23%. So an awful lot of the expenditure that the government has engaged in has in effect been saved, not actually necessarily saved by the same people, and the implications of that are quite large. That means the question is, what is going to happen to all these savings once lockdown ends? And I suspect we're going to spend some of that money, but not a lot, and not very quickly. You know, we're not going to be able to take the foreign holiday we didn't take last year, although we might do a bit more traveling. But even then, I think traveling and so on will take some time to get back to normal. So I'm more worried about the slowness of the recovery than I am about the deficit and the financing of it.
John, in saying that, the average maturity of UK government bonds is over 15 years, which is quite long in an international context, but due to the quantitative easing, a third of those bonds are held by the Bank of England. Also, there is so much in terms of liabilities held in respect of the deposits of commercial banks. And if you take all of the short-term paper into account, treasury bonds, etc., you do get an incredible shortening of the kind of average duration. Indeed, it goes as low as just over a year by this time next year. Does it not leave the UK economy very vulnerable to a rise in interest rates?
We were certainly too vulnerable. I'm bound to say I've never been a great fan of quantitative easing. And I think the business of, at current interest rates, we should be financing this debt with as long maturity as as we can. And given that there is still a large appetite for very long dated paper, I wish we were selling a lot more of it. As you say, the average maturity of government debt is really quite misleading, because so much of it is owned by the Bank of England, and the Bank of England is just us wearing another hat.
Indeed. Yeah, I mean, I was reading that an extra 1% on interest rates across the yield curve would add 25 billion in terms of interest servicing cost, which is huge per annum.
We shouldn't get overwhelmed by that. That's 1% of GDP.
Yeah.
Yeah. But it means 1-2%. It's not that big a deal in terms of overall public expenditure. But it would still be much better if we were financing this with long-term borrowing rather than short-term borrowing. That creates a problem, however, on its own, which is that who is buying this very long-term paper? And the answer is that a lot of it is going into pension funds and similar people with long-term obligations. And the ability to provide decent pensions on the basis of paper that is realizing negative rates of return over the long term is quite worrying. I think it's another one of the ways in which we need to worry about the intergenerational aspect of distribution. I think almost everything that has happened in the last 20, 30 years has kind of favored my generation at the expense of the generations that follow us. And I can't feel very good about that.
Yeah. I mean, John, switching to the question of investment, productivity gains in the UK since the financial crisis have been quite deplorable. In fact, I think we only outperform Italy. And I don't think we see any obvious resurgence in investment. And I guess that one could argue that the kind of bonus culture for management has focused them on using profits to boost share price rather than invest. Do you think Sunak's doing enough in that regard, or do you think he could do more?
I think that's a complicated set of issues. I think, first of all, there's a question of how we interpret this kind of productivity data. And if we think of, the ways we measure productivity date from the days we were talking about stuff coming off an assembly line. Mm. And if it came off faster, our productivity had increased. We're using Zoom at the moment. Ask what is the effect of that on productivity? And that's very difficult to work out. Mm. And we're making use of all kinds of modern technologies in ways that simply don't show up in kind of conventional measurements of output. That's a reason why I'm less worried about all of this than some people are. I'm just not sure that our measurement is all that good. As far as investment is concerned, I think people haven't yet understood the degree to which modern business has changed. Again, going back to, I've written that we write about 20th century business as if General Motors was the archetype of the firm. The production line, commodity labor force, capital intensive plant. Almost none of that is true of modern business. If I look at companies like Amazon and Apple, I find there's absolutely nothing on their balance sheet except cash. These companies don't anymore own, there isn't very much plant, physical investment in the business, and they don't own most of what is there. So I think productivity and investment at that level, I'm less worried about. Whether we're actually developing the right kind of capabilities for 21st century businesses. Britain has done moderately well in kind of tech areas. We're way behind the United States, but at least we're ahead of some of our continental European countries. But I think that's where we need to be looking, and that's where we need to be focusing. I am concerned, as you've described, by the way in which the bonus culture has helped to create a lot of dysfunctionality in finance, in which managers are focusing on managing quarterly earnings rather than actually building up these long-term capabilities in the business. But I'd much rather talk about these long-term capabilities than I would about emphasizing plant and machinery and things that matter less to business than they once did.
Okay. The bond markets in the last few weeks, John, have given a signal that there is more concern or rising concern about the inflation prospects. And I guess that's been fueled in part by Joe Biden, you know, declaring a very lavish plan of fiscal stimulus, which is much, much bigger than that which was used in the post-global financial crisis. What's your take on the prospects for inflation, and should we be worried about it?
I think I'm not too worried by that. I think there are two parts to the worries people have about inflation. One is about levels of government spending. And frankly, I think at the moment, the key is going to be getting people back into productive work. And if government expenditure is going in these directions, that's good. I'm slightly worried about the tendency and all of that to bias things in favor of rather grandiose projects. As I've put it various times, I'd like to see more spent on filling in potholes in the road and rather less attention to building a tunnel between Stranraer and Laugharne. But there's a political bias which tends to rather favour the Stranraer-Laugharne tunnel. Okay.
John, in the last year or so, you've been, as ever, writing books, and one which you wrote 40 years ago, a book which you collaborated with the then future Governor of the Bank of England, Mervyn King, and last year you co-wrote another book, Radical Uncertainty, Decision Making Beyond the Numbers. It did remind me of, in the pre-COVID time, which seemed a lifetime ago, that I was standing at a reception with you in London at the Ivy Club, talking about the difference between risk and uncertainty, and how so many people fail to understand it. But it seems to me at the heart of what I found a very eloquent and enlightening book, the notion that we see sort of too much impoverished decision-making based on sort of so-called well-defined probabilities. I'd quite like you to maybe just give us a flavour of that, because clearly we've heard so many politicians say follow the science. And maybe if you don't mind, would you mind just giving our viewers the example of Barack Obama's decision to whether or not to launch the attack to kill bin Laden, which when he may or may not have been in the compound at Abbottabad?
Yeah, we'll start with a commercial break, which I think we if anyone on the call hasn't bought it, they ought to go out and do it. And one of the signature examples with which we begin, as you've said, Benny, is the Barack Obama in 2010. Does he order the raid on the Abbottabad compound? And spy satellites have identified a tall man with long beard wandering around this compound in Pakistan. And the question is this Osama bin Laden or not? And after a lot of intelligence failures in the Iraq War, US intelligence agencies were told, you have to express your findings in probabilistic terms. So the question people in the White House Situation Room are discussing is the man in the compound bin Laden or not? And Obama is presented with estimates of the probability that it's bin Laden that run from 25% to 95%. And at the end of this conversation, Obama says, look, guys, it's 50-50, isn't it? It's a flip of the coin. By which I'm sure he didn't mean the probability that it's Osama bin Laden is 0.5. What he meant was this was a completely one-off situation. He didn't know, and his agencies didn't know, whether it was or it wasn't bin Laden, but he had to make a decision anyway. And that's the situation with which we are so often faced. It's essentially a one-off situation in which there is no basis for attaching a probability to any particular number. And one of the heads of the US agencies described the difference between mysteries and puzzles. A puzzle is something where it's a question that has the right answer. And it may be difficult to find out what that answer is, but there is a right answer. And when you found it, everyone will agree that that is the answer. But what we so often have in business and finance is not puzzles, but mysteries, where the problem is not very well defined. And you may not know what the answer is even after events have occurred. So what should Obama have been thinking? Well, people think much more naturally in terms of stories than they do in terms of probabilities. And that's right, because the situations where probabilities are useful are not actually all that frequent. Probabilities are really useful if you're playing games of cards or playing roulette or whatever, although they're mainly useful as far as roulette is concerned. You shouldn't do it. But probabilities are helpful in these kind of problems. And they're also helpful where there are large databases generated by what we describe as stationary processes, things that remain change pretty slowly, if at all. So mortality tables are good examples of where these kind of probabilistic reasoning is useful. But as far as problems like the one Obama was faced with, they're not useful at all. And afterwards, after that discussion, Obama said in an interview, people kept giving me these estimates as probabilities, which I found were serving to disguise uncertainty rather than illuminate it. And what I'm sure happened with Obama was there was a conversation in which people talked about the things they did and they didn't know, and then about the mission which they were planning and the range of things that might go wrong with that mission. And on the basis of that conversation, that story, if you will, Obama had to make his decision as to whether he authorized the raid or not.
John, how would you characterise the way in which the UK government has tackled the health crisis, first of all, in terms of deploying either the science in an excessive or inadequate way?
It's a story that raises a lot of questions in relation to radical uncertainty and the way we talk about it in the book. Interestingly, and we don't claim any precedence for this, we said in the book, having written this back in 2019, that it is likely that the world will have to face up to a pandemic caused by some virus that does not yet exist. Page 40 of the book. And that's exactly the kind of thing where we can say this sort of thing is likely, but there's no sensible way of saying we can attach a probability to that. And certainly you can't say the probability that it will break out in Wuhan in December 2019. You can't do that kind of thing. What do you do then? Well, we've known that this kind of pandemic could occur. What we need is to develop systems that are robust and resilient to events of that kind, which we know will happen, but whose incidence we can't predict in any specific way. Now, when this broke out in early 2020, we didn't have in most areas that kind of robustness and resilience. We didn't have the potential spare hospital capacity, although we did quite well actually at constructing some of it. We didn't have the slack in the system in a lot of ways that Germany had. We didn't have the stockpiles of necessary equipment that, for example, Switzerland had. We didn't have adequate preparation for that kind of thing. And we didn't have an effective basis for a test and tracing system. And I think we'll have an inquiry into this and a lot more will be revealed. But I think one of the big failures was failing to test and trace effectively at the beginning of the pandemic. And a lot of that was because in the UK, and we have an over-centralised system in which Public Health England essentially insisted on keeping control of all the testing facilities for 2 or 3 months of the pandemic, although there were quite a lot of university and even some commercial labs that would have been able to ramp up testing capability very rapidly. That, I think, is the biggest mistake we made. The thing we've done well, of course, has been the vaccine development and rollout. And that's a good example, I think, of an effective public-private partnership, where the public role has been to provide funding for basic research and to assure commercial producers that there would be a market for their product if they produced one. And we've done very well in being able to buy vaccines on that kind of basis. And we seem to have done pretty well in managing the rollout as well.
I do recall, John, as some of our viewers may not know, you were part of the advisory group on economic recovery in Scotland, which I was chairing. And you did say at the very outset that you felt that much greater levels of testing would have enabled us to understand what was going on much more clearly, and that would have aided the decision making itself.
Yeah, we didn't even know until well into the pandemic how widespread infection was in the community. Yeah,
absolutely. Yeah. To give you a chance to plug another book, John, the other book that appeared last year was one that you co-wrote with Paul Collier, Greed is Dead, Politics After Individualism. I mean, I found it a delightfully interesting book, if a little bit of a polemic at times. And it did remind me, actually, in January 2020, the Tory grandee Kenneth Clarke was interviewed, you know, the famous Lunch with the FT interview. And over his bottle of Chateau Paysa, he said that he thought that the 90s and 2000s were perhaps wasted when things were going well and we hadn't really thought enough about making sure that living standards were more broadly raised and then maintained. I mean, could you maybe talk a little bit to the essence of your book? It struck me as quite resonant with that comment.
Yeah, second commercial break, Penny. And it's perhaps worth saying, you quite rightly say that this book is a bit of a pandemic. It makes me sound ridiculously productive, having published 2 in 1 year. But actually the one with Mervyn King, the Radical Uncertainty one, was the much more earnest book, which was several years in the making. Whereas the one I wrote with Paul took 6 months essentially from a discussion we had over lunch, at which we said we need to write something about all of this, and went ahead and did. I think you are. This goes deep, actually, into the way in which politics has been developing. Actually, it's the way in which the political left in this country. And this is true in the UK, and it's true in Scotland as well, but in rather different ways. The way in which the left is now split between an elite that is focused on issues about identity, politics, gender identity, race, and the likes, which has got away from the traditional left preoccupation with economic issues. And that's why it is that in the north of England, Labour lost 50 seats that are the reason why Boris Johnson came back with his large majority. And there's a different story in Scotland, where we have where the SNP has essentially wiped out the traditional Labour party in Scotland, but now has splits of its own on some of these sort of lines. What's this is about in our mind is not just a matter of inequality. We talk in the book about, we take as exemplars a couple of the seats in the north of England that Labour lost to the Conservatives last year. Classic examples of seats that 50 years earlier you hardly even had to bother counting the votes because the Labour majority was so large. We took Don Valley and Stoke-on-Trent Central. And these are not particularly poor areas. They certainly don't have a high unemployment. Unemployment is quite low. they're below average in terms of per capita income. But the worst constituencies in terms of income per head are to be found in inner cities, and they're still predominantly labour. What has happened there is the nature of employment has changed. In Don Valley, it used to be mining and steel. In Stoke, it used to be ceramics. Mining is now dead in this country. Steel is largely migrated overseas. Ceramic production is overseas. The largest employer in Don Valley, we suspect, is Amazon. It's a logistics centre, and there are a lot of warehouses there because it's well connected with motorways. The largest employer in Stoke-on-Trent, this goes from bad to worse, is Bet365, which is the online gambling facility. There isn't the same community and job satisfaction in these kind of areas and these kind of activities that there was. I mean, mining was a horrible job, but it had created a very strong sense of community. And these kind of communities have largely gone. And unless we can restore equality in that kind of sense, we talk of it as equality of respect, rather than just equality of income, we're not going to have a united country anymore.
Yeah, I think, and you made a reference to Labour in Scotland, John. I think it would be difficult to argue also that Labour in Scotland specifically did take the electorate for granted and paid a heavy price. And I guess that's something that everyone has to be careful about. In terms of this greed is dead, I also, it struck me that you were striking also at the heart of some hypocrisy, and certainly, say, for example, in California, where we have these woke elites, and I guess California is a little bit on the news at the moment, but I mean, do you want to say anything, not about that specific subject, but the more general woke elites and the hypocrisy, where in California you have huge homeless problems, and yet everybody talks about how important it is to maintain a better society?
I don't have to go to California to find woke.
No.
Oxford, I find a fair bit of that. To hear Oxford students who are actually, by any objective standards, among the most privileged people in the world, both being very well looked after, or at least being very well looked after in non-lockdown times, and on fast tracks to the best countries, best jobs in the country, to these kids claiming to be victims of multiple kinds of intersectionality, makes me pretty angry and pretty fed up. And if the price of coming to Oxford is have to pass a statue of Cecil Rhodes occasionally, then I think people in Don Valley and Stoke-on-Trent would not be impressed by the victimhood which they believe they're suffering.
Thanks, John.
John, anger over the issue of the woke elite versus real concern with economic status and respect and dignity in the workplace. That's kind of why Paul and I got into polemical mood.
Very good. Well, John, I think we're going to draw this part of the conversation to a close, but we'll be back for the questions later in the webinar. And now I'd like to hand over the reins to Derek.
Thanks, Benny. And good afternoon, everyone. Thanks for the informative session there from Benny and John. And thanks everyone for continuing with us as we look through the budget announcements. I've listed here what I'll discuss, and without any delay, let's have a look at the increased corporation tax that was announced. So the Chancellor confirmed in his budget that companies have benefited greatly from the government's range of COVID support. As a result, he felt it just to ask them to be the first to contribute to the economic recovery. This will take the form of an increase in corporation tax from 19 to 25% where profits are greater than 250,000. And this won't apply until after the 1st of April 23. Companies with profits up to 50,000 will still pay 19% corporation tax. And where profits are between 50,000 and 250,000, companies will access a relief known as marginal relief to offset the rate of moving from 19 to 25%. So for those of you who can remember, you'll recognise this system of tax, and it was removed for profits arising after the 1st of April 15, but we're now returning to that. And the increased rate of tax, as the Chancellor wished, still has the UK as the lowest corporate tax rate in the G7 countries. Now looking at the extension of loss carryback. In response to the effect of COVID, many businesses will see more losses arising, and therefore there's been an extension to loss carryback relief for companies and self-employed traders. The enhancement only applies to losses incurred through trading. And the way the relief will work is that losses can now be carried back against profits taxed in the previous 36 months, rather than the rules just now, which allows the carryback for 12 months. This will apply for companies for losses arising after the 1st of April 2020, and will continue in place for losses arising up to the 31st of March 22. For self-employed traders and partnerships, this will apply for losses arising in tax years 2021 and 21-22. The intention behind the extension of loss relief is to allow these traders to access cash repayments of previously paid taxes. The current rules allow an unlimited loss relief carryback for 12 months, and these remain unchanged. But the extension is subject to a cap of £2 million of losses that will apply in the years 2 and years 3 for the carryback. This cap of losses will apply on a period-by-period basis. Without going into examples just now, I've included these in the slides we'll make available to you after this presentation. The Chancellor also introduced a super deduction for plant and machinery. Where businesses purchase plant and machinery for use in their trade, for 2 years from 1 April 21, the business will receive a tax deduction equal to 100% of the cost of the asset. The asset being purchased must be new, and it must fall within a specific qualifying criteria that would normally qualify for 18% annual capital allowances. Assets such as cars and assets for leasing will not qualify for this super deduction. And the super deduction will provide 25 pence relief for every pound spent on plant and machinery. And that will be the case if your company's tax paying. There's also an enhancement to 50% first year deduction for plant and machinery assets that fall within what's known as the special rate pool. And this enhances the current 6% capital allowances for such assets. With the super deduction, there is also new rules to deal with disposal of plant and machinery where the super deduction has been claimed. In such situations, the disposal receipt will be enhanced by 1.3, and the result will be processed as a balancing charge for tax purposes. The receipt won't simply be taken through the capital allowance pool as happens just now. Provisions will also apply to prevent the super deduction being available where there's already a contract in place for a business to acquire a new asset, and where that business delays the acquisition until after April 21, the super deduction won't be available. Again, to allow you some understanding of this, I've included some examples in the slide pack that we'll make available after this presentation. So while looking through these new information that the Chancellor's released, I can't help but contemplate that the value of R&D tax relief for small and medium-sized enterprises has been increased. R&D relief provides SMEs with enhanced deductions available against taxable profits for qualifying R&D expenditure. And on many occasions, the taxable profits are turned to losses, or existing losses are increased. The temporary loss carryback extension will allow some SMEs to make R&D claims and access relief for losses at 19% against previously taxed profits, rather than surrendering such losses for a 14.5% payment from the HMRC. Looking ahead to the 25% tax rate, some loss-making SMEs will also need to consider whether it's worth holding on to their losses for relief against future profits to be taxed at 25%, rather than giving them up for a payment from the government of 14.5% of the losses. And lastly, when the tax rate increases to 25%, R&D itself will become more valuable. Therefore, we would recommend all companies consider their innovation activities which all companies have, and ensure they're maximising their claims for R&D tax relief where these are available. But the budget just didn't come with enhancements to R&D relief. From 1 April 21, a new constraint to R&D relief will be introduced. The government have been concerned that loss-making SMEs can access significant payments from the government by surrendering their losses and not make any significant PAYE and NIC payments. HMRC feel this isn't just, and as a result, a cap will be introduced from the 1st of April 2021 for the payments the companies will get where they surrender losses. This caps the payment at £20,000 or 300% of the company's PAYE and NIC bill. There are some exceptions to this, but where companies are creating intellectual property. But in general, the cap will need to be considered by all companies that are loss-making and make R&D claims before they make a loss surrender to the revenue. We have a blog on our website that provides more information on this, but if you would like to discuss the impact on this further, please don't hesitate to get in touch with me. The Chancellor went on to explain that he wishes to influence the innovation behaviour of UK companies by using R&D. And he also announced a new consultation that has 4 objectives. He wishes to maintain the UK as an innovation superpower in the world. He wants to boost spending on R&D by UK companies. He wants to ensure that the existing R&D schemes remain relevant, and he wants to prevent abuse of the existing R&D scheme. So I would suggest in the autumn budget, we're likely to see further enhancements to R&D tax relief, and possibly also further funds to allow HMRC to inquire into perceived abuse. We'll keep you up to date on this still further. Now, the 6th of April 21 will see the expected new IR35 rules apply to the private sector. This is known as the off-payroll worker rules. These new rules will require an individual's status to be determined and PAYE and NIC operated if they are deemed to be an off-payroll worker. In simple terms, if the individual providing their services performs the services in the same manner as an employee of the end user, the fees paid for the services must be subject to PAYE and NIC. Failure to operate the rules correctly can cause the fee payer, and on some occasions the end user, to be stuck with the liability for PAYE and NIC, something they won't want to be doing. Small companies are exempt from the new rules. They must continue to operate IR35 as it stands now. And this leaves just medium and large companies, together with some charities, to operate the new rules. It should be noted that it's the size of the end user of the individual providing personal service that is relevant when considering the small company exemption. And this will be an area where mistakes will be made and unexpected liabilities will arise. So please take care. The outcome of the new rules is increased administration, an obligation to take reasonable care if you are engaging with a personal service company. Failures will cause unexpected tax, and there'll be interest and penalties. And in some cases, applying the rules incorrectly could result in a company losing their contract with some end users, as the end user will not want associated with tax failures. But what hasn't changed? There was so much noise before the budget about what changes were expected, and I've shared some of these on the slide. You can see here CGT and inheritance tax were expected to change. CGT for an increase and inheritance tax for some of the relief to be amended. This resulted out of a report from the Office of Tax Simplification, although I'm not sure it was simplification that was being produced. Also, significant profits being made by online retailers as a result of increased usage through COVID was expected to spark a new online tax. And this would replace tax lost from rates that retailers wouldn't have paid since COVID began. However, none of this materialised, with the Chancellor taking time during his speech to promise an honest approach to tax changes. It seems he intends to make changes only after taking advice, which has been made publicly available for input. The outcome of this is the announcement of a tax day. This tax day, which is a new concept, will fall on the 23rd of March 21, and it will be used for the findings from a number of tax-focused consultations to be announced. The Chancellor really wants these consultations to be given their own space and consideration, because they're important to the future of tax in the UK. A call for comments from parties interested in the consultations will be requested. And the Chancellor's doing this in order that it can, in his words, introduce the right amount of tax changes to deal with the right matters in an honest fashion. Therefore, much of what is in the consultations is likely to be included in an autumn budget statement. And we'll continue through our social media channels to keep you updated on the proposed changes and where we think tax changes will go. Thanks for listening, and I'll now pass you on to Alistair Duncan, who, through some video, will comment on indirect tax matters from the budget.
Good afternoon, and thank you, Derek. From an indirect tax point of view, last week's budget was more interesting than most. Not only did we get the introduction of a new VAT rate for the first time in a number of years, but we also had the reintroduction into the UK of Freeports. So what exactly is a Freeport? What we have in a Freeport is an area of the UK that for tax purposes is effectively outside the UK's borders. That allows that Freeport to benefit from a number of customs and tax reliefs which assist in the development of economic activity in that area. So in the UK, last week, we had the introduction of the 8 Freeports in England. We'll speak about Scotland shortly, but in England, the model that Rishi Sunak has announced has a number of tax reliefs. The tax incentives that we're seeing in the Freeports going forward will be structures and building allowances, enhanced capital allowances, some stamp duty reliefs, full business rate reliefs, and where you employ new employees into the business in that area, there will be 100% NIC relief. And from an indirect tax point of view, the important one for me is the number of customs reliefs that are available. Now, whilst we've seen enterprise zones in the past where you will get enhanced capital allowances and business rates relief, it's the package of measures that you get in a Freeport, coupled with the fact that it's treated as being out with the UK for tax purposes, that gives the Freeport that added benefit from other enterprise zones. Looking at the customs reliefs, where is it going to work under the model, again, that was announced last week? What we're looking at is custom simplifications, which means it'll be easier to make declarations and bring goods into the free zone. There will be duty deferment, which means that when the goods come into the free zone, the duty won't be due until such time as they're then removed from the free zone into the UK. And it's only at that point that the duty will be due. There will also be inward processing, which allows goods to be brought into the free zone, processed into finished products, and then re-exported from the UK again. All the time that they're in being processed, there is no duty, and then it's suspended when it's removed from the UK. And finally, we have duty inversion. Duty inversion is where the duty on the raw materials that are coming into the Freeport are higher than the duty rate of the finished product that's been removed from the Freeport. In those situations, all that will be paid is the lower duty of the finished products when these goods are removed from the Freeport. Again, a lot of the reliefs and simplifications that are available within the Freeports are available elsewhere. The benefit, again, of a Freeport is it's packaging these all together to give an easier and more beneficial way of achieving those benefits. Scotland has gone a slightly different way in that Scotland are looking to introduce what they're terming as green ports, and that is intended to be 2 green ports in the UK, in Scotland. As yet, they have not announced where those green ports are going to be. And the main difference between the Chancellor's Freeports and the Scottish Government's green ports is that it is intended that these will be looking at scenarios such as Fair Work First principles, the adoption of the Scottish Business Pledge, and also the commitment to move towards Scotland's carbon net zero commitments. So again, you can see that the green ports in Scotland will mirror very much the Freeports, but with that added green and business initiatives. The other area that was discussed at the budget in the same vein was the very welcome announcement of the £27 million investment for the Aberdeen Energy Transition Zone. And this is designed to move Aberdeen in the northeast away from the dependence on oil and gas to support the development of more green energy sources such as offshore wind, hydrogen, and carbon capture. The other area that was key from indirect tax is the extension of the reduced rate for the tourism and hospitality sector. At the height of the COVID pandemic, the Chancellor announced a 5% rate for the hospitality and tourist sector, covering such areas as restaurant and catering, hotel and holiday accommodation, and admission to attractions. These were all liable to VAT at the 5% rate. Unfortunately, due to the continuing extended lockdowns and more strict lockdowns, these businesses didn't actually get the benefit of that reduced rate. As a result, the 5% has been extended until the 30th of September. At that point, a new 12.5% rate will be introduced, which will cover the 6 months from October 21 through to March 22. And at that point, it's expected that the VAT rate will revert back to 20% from the 1st of April 2022. Obviously, there's a lot of time between now and April 2022, and we would hope that the Chancellor may look to extend a reduced rate for the hospitality sector and the tourism sector going forward. But at the moment, we're expecting that to revert back to 20%. I'll hand you back now to Benny, and Benny will go us through the Q&A section.
Thank you, Alistair, and thank you also, Derek. We have some questions that have come in. I'll start with a question for you, Alistair. And the question is, are the introduction of free ports and green ports a benefit of Brexit, in your opinion? And perhaps I could add a supplementary question. Is it really a benefit at all, or is this simply a redirection of activity and revenue potentially?
Thanks for answering my question, Benny. Yeah, so I would say it's not really a benefit in any event. Looking at it from the 2 points, did Brexit make any difference to the introduction of free ports? Well, the fact that we've got more than 80 free ports elsewhere in the EU shows that you can have free ports, and we could have had free ports before Brexit. A lot of the reliefs that are available within the free port are available elsewhere. As I said, the main benefit is it's all packaged together. But what it will do is it will just attract any investment to those areas, perhaps away from existing areas rather than from out with the UK. And if all it does is redistribute what is already there to those 8 in England and the 2 in Scotland, it doesn't really help the position. So in my view, definitely not anything to do with Brexit, and arguably it's a redistribution rather than inward investment incentive.
Alistair, is there anything about the nuances that relate to the Scottish version that gives rise to any benefit or detriment, or is it really not terribly relevant? I mean, albeit fair work is very important.
Yeah, I would say it's again the fact that you're adding those additional aspects to it and having that focus on you know, the direction of travel that the Scottish Government wants to go to around transitioning the energy sector, moving towards that net zero target. All of that is, you know, you could have done that with other reliefs, but it's wrapping it up with that Freeport and ensuring, in some respects, that we don't lose what's happening in Scotland to Teesside or to the Humber or whatever, who will have a Freeport.
No, great. Thanks, Alistair. That's pretty clear. Derek, a question for you. Does the super deduction apply to assets acquired on hire purchase?
Yes, it does. In short, there are some conditions associated to that. You must have the business incurring the expenditure must have a true HP contract under tax legislation. So the hirer of the asset must be making the periodic payments. And there must also be an option in order to acquire the asset at the end of the HP term. If you meet those conditions, then the super deduction will be available.
Okay, thanks, Derek. Another question for you. This is somewhat more speculative. Do you have any sense of what the details around a wealth tax would be?
Now, that's a really good question, very speculative. 23rd of March, tax day, should give us a little bit more about that. But there has been a report that was commissioned from the government in December 2020, which goes into this in some detail. And really looking at this, you could have an annual wealth tax, you could have a one-off wealth tax. Both of them, I suppose, saying what they are on the tin. If we look at the one-off wealth tax, very much driven at filling the tax coffers. So you would set a bar of net wealth, taking into account everything one owns, less any debt. And you would apply a percentage to that. So very targeted and very one-off. The resultant tax liability could be required to be paid up front. That could be very harsh because a lot of people's wealth is in illiquid assets. So they would need to realise that. So you would imagine that the wealth tax would have to be paid over a period of 5 years or so. But the problem with a one-off wealth tax, in my mind, would be, would it be possible that anybody in the country would believe that that would be a one-off? Would there be further one-offs coming down the line? But it would certainly raise a lot of money for the government. An annual wealth tax really looks at two things. You can tackle inequality there, spreading the wealth. You could also raise tax. So I suppose it could be targeted in two ways. Again, set out in the same way, you would think the percentage would be less, applying in a targeted manner to the wealthy. In both situations, the wealthy still have inheritance tax to deal with, although many would say inheritance tax is able to be avoided in some way. You can take advice on that. But there are targeted suggestions for dealing with that too. So the wealthy would say, is it fair? The less wealthy would say, yes, it is. And I think the problem would be the very wealthy. Would they want to stay in the UK? And what would be the impact on the UK for that? If you look at entrepreneurship and growing innovative businesses, that isn't an area that the banks can assist anymore. And it is the realms of the wealthy that are standing behind these companies to get them stood up, to get them started. So I think it would need a lot of debate. I don't think it should be rushed in. And I think, will we see it in the autumn? I don't think so.
Okay, well, yeah. Thanks, Derek. I think that puts helpful context around that really interesting question. John, I'd like to try and ask you a a couple of questions or so before we run out of time. First question is, you referenced the intergenerational inequalities. What can be done about it, and should there be specific incentives?
It's a more complicated issue than it looks, and this in a way goes back to Derek's observations about wealth and inheritance taxes. And inheritance taxes typically have been largely avoided by the very wealthy and fell on the moderately wealthy. But more importantly, what is happening is that obviously the wealth which our generations have accumulated will be passed on to subsequent generations, but they'll be passed on in ways which actually perpetuate inequality into successive generations. And that for me is the most disturbing aspect of this. It's also the case that if we die at the ages at which we typically do, we tend to pass them on to our kids in their 50s and 60s, which is not the time of life when they're going to benefit most from receiving this kind of money, as I think we know. So that my favoured means of trying to tackle it would be a more effective inheritance tax regime. But we know both the difficulties there are in achieving that and the amount of political resistance there is to doing that. I think wealth tax type measures, international experience of wealth taxes is very discouraging. And we have to cope with a very large numbers of people who are asset rich and cash poor, which is the product of the way the housing market has resolved. I find this a very difficult issue. I wish we had not messed up defined benefit pensions so much, which are, I think, one of the important ways in which we achieved this kind of equality more effectively and have imposed pretty considerable burdens on our children and grandchildren in ways I rather regret.
John, another question that's come in is, what's your view on what looks like a potential summer and perhaps even winter of discontent in relation to public sector pay, when government will make the plea that there is no money, but of course many will say there is money when we need to find money. How do you think that will play out?
I mean, the political ineptitude of announcing a 1% NHS pay rise in the last week kind of beggars belief, really. This is a can which sensibly have been kicked some way down the road. I do find it actually startling that a government which seems at one level to be almost obsessed with its PR management has walked into obvious disasters such as this one, or the disaster that occurred last summer over A-levels and test and examination systems. And I think there's going to be another, if different, disaster this summer. I think what is left feeling, we have a government that is not very good either at managing the big economic issues or at managing the politics, which is what these people's claimed attributes actually are. It's very discouraging.
Sadly, I do think that it's the short-termism of solving problems that gets in the way of solving the bigger problems that require a little bit more vision and foresight. But they just seem to try and tackle one little thing right in front of their nose at times, which backfires. John, we have to bring the session to a close. Going back to, I think it was the Greed is Dead book, you referred to the Athenian democracy having buckled and never recovered from the plague in the 5th century. As you look forward to how we will recover from this plague of sorts, what do you hope for and what do you fear?
It's a very disturbing analogy because the Athenian plague, as it were, put the seal on what was already the decay of Athenian society for some decades before that. and one can see all too easily analogies there. I would like to hope that we can simply attract more capable people into our political system. And if people can actually see a government which they can have confidence in, I don't mean this in an ideological sense, I mean just in terms of its competence to handle everyday issues in the way Germany has achieved under Merkel, and one hoped France might be capable of achieving under Macron, but that does not seem to be working out in the ways in which we hoped. But it's really politicians of the caliber to take that long-term view and inspire public confidence about the management of the crises and the uncertainties, the radical uncertainties as we've described it, which will inevitably produce unexpected events.
Okay, well, look, thanks, John. It's always a pleasure, an odyssey through many, many subjects in the course of the last hour. And thank you also to Derek and Alistair for your splendid presentations and taking the questions. From everybody at AAB, I wish you well, stay safe and take care. And hopefully next year, lunch will be back on. Thank you. Bye-bye.